Mutual funds have become a buzzword in the investor market. In this video, we will learn some basic fundamentals about mutual funds. But what are mutual funds? Let's start with a short story. Imagine there are 20 people in town. All are earning well but have no idea about where to invest their money. There is a wise man in the village. So all 20 go to the wise man to seek his advice. The wise man thinks that instead of giving advice to everyone individually, let's pool all their money together and create a fund. And from that fund, I will invest. Ultimately, whatever the funds will earn will be shared among all the people. So indirectly, they will earn from the market without bothering about where to invest. This is the whole concept of mutual fund. Mutual funds pool money from the investing public and use that money to buy other securities and give back the returns to the public. Now comes a very basic question as why to invest in mutual funds? You must have heard that never keep all your eggs in one basket. This is called diversification. Mutual funds invest in various securities to diversify your portfolio. The second reason to invest in mutual funds is that your funds are professionally managed by experts. So even if you don't have any knowledge about stock market, no worries. The last reason to invest in mutual funds is that risk management is done profoundly by mutual fund managers. The volatility in share markets is called as risk, which is efficiently reduced by mutual funds. While buying a mutual fund, there are three things which you should look out for. First is expense ratio. Since the mutual fund is run by professionally qualified management, they charge a certain percentage as their administrative fees, that is expense ratio. This money is going out of your pocket. So lower the expense ratio, more beneficial it is. The second thing to look out for is exit load, which are the expenses one has to pay while selling the mutual funds. Since the money is going out of your pocket, so the lower the exit load, more beneficial it is. The last thing to look out for is CAGR. CAGR, that is compound annual growth rate, is the annualized growth rate of the mutual funds. It is the same like interest rate on FD, but the only difference is it's not fixed. Now let's look at some of the very common myths about mutual funds. First, mutual funds cannot be sold up to 1 year. Majority of the mutual funds don't have a lock-in period and they can be sold within a time span of 2 to 3 days. The next common myth about mutual fund is that they are very risky. Mutual funds are risky, but risk management is done very well by mutual fund managers. The third common myth is that mutual funds give very high returns. Mutual funds are not some lottery tickets. They give moderate returns, that is, not very high, not very low. Fourth myth is that minimum amount to invest in mutual funds is rupees 1 lakh. This is absolutely false. You can start investing with as low as rupees 500. Last myth about mutual fund is that past high CAGR is a surety of future good performance. Not necessarily. Performance of mutual funds depends a lot more on present economic conditions rather than past. But if you stay invested for a longer period of time, there is more probability of earning high returns. So the three things that we have learned while selecting a mutual fund are expense ratio, exit load, and CAGR. But out of so many mutual funds, how to select and invest in the right one? We will be learning this in our next video. So if you like my work, please hit the like button and don't forget to subscribe. You can also connect for more such videos on Instagram. Thank you so much.